Good morning and welcome to the Monday Call. I'm Stephan Clark, Chief Client Officer at NZ Funds. At the beginning of the year, experts predicted a lacklustre performance from financial markets and the economy. Now, halfway through the year, the experience and outlook have taken a different turn. Depending on where you look, all four stages of the business cycle seem to be unfolding at the same time. Economic activity is generally robust and a US recession is less likely. Inflation appears to be under control in most major markets and interest rate rises have either stopped or are slowing. Share markets are rising, particularly those connected with the US technology sector. Yet, consumer confidence remains low and unemployment is expected by many to rise. This week, we're joined by Mark Brooks, NZ Funds Head of Income, and we're going to try and make sense of the data and explain how, as a firm, NZ Funds is positioning client portfolios to take advantage of the opportunities the current market is presenting and manage the risks that are currently at play. Mark, fantastic to have you here.
Morning, Stephan.
Let's kick off with, at a high level, let's kick off with how, the broader market and how you're seeing things having changed from year to year.
Yeah, definitely. I think if we look back at the start of the year, the interesting point to note is that as we went into the year, really the expectation was that things were going to be relatively challenging, I suppose. You would come off a year where central banks in New Zealand and around the world had rapidly raised interest rates and really at a pace which we haven't really seen since the 1980s. And coming from such low levels, it was very much an unknown as to how that would translate through, but most really felt that would come to bite at some point. And to a degree, we did have that to start with the Silicon Bank crisis in the US, where you had an event or something crack in the sense that actually we've had really aggressive rate rises. Has that gone too far? Has that been too much for the economy? So, very much the thought process was we've had these rate rises, but at the same time, inflation's been really strong. Is it under control? Question marks over whether the banks had to do more. So really there was uncertainty over where interest rates were going and whether, yes, they were probably near the peak, but there was a real chance that they actually pushed a decent amount higher. And really, on the flip side of that, from a growth standpoint, was that recession was probably, most people tended to expect, I think most forecasters had a 45 to 55% chance of recession for the US economy. Clearly, New Zealand is actually technically in a recession at this point, but for the US economy, a high probability recession, and actually a fairly decent probability of actually a deeper recession. So all of that sets up quite I suppose looking ahead, quite a lackluster year in markets. What we've found is actually, in many ways, the complete opposite. We've actually had really that sort of Goldilocks type scenario where first growth ended up being quite a bit stronger, especially in the US, but also, in New Zealand, it's still, while slowing, it's remained robust. I think it's probably in the face of the interest rate rises. So really growth around the world has remained pretty robust. At the same time, so that gave people confidence that you could take out that sort of deep recession expectation. And then more recently, we've really had sort of some quite positive news on the inflation front. And so in many respects, you could actually say you've almost got a Goldilocks sort of situation where growth is not bad, not too hot, not too cold, but kind of just right. And at the same time, there's some quite promising data coming through on inflation. In New Zealand, we had inflation data last week at 6%, which is better than it's been. It's probably not the fantastic result, but I think the really important bit is as we look around the world, you are starting to see outside specific economies, some real progress in inflation. In the US, headline inflation is now 3%. That's a long way below their peaks of sort of, where they get up to 9, I think, at one point. And they're seeing material moves down in terms of, certainly in the goods side, and starting to see progress on that on the services side. So, I suppose the markets have all of a sudden got very comfortable that, the inflation genie may actually be moving back in the bottle. And whilst the actions in terms of interest rates have seemed aggressive, and they have certainly been aggressive, that the economies so far are being able to take that in their stride, which all in all is quite a good setup for markets. And that's what you've seen generally quite, much more positive markets than people probably had expected.
Okay, so we'll talk about the details of the markets shortly, but there have been some economies where the genie hasn't been put back in the bottle, isn't that right? UK is one of them. You want to take us through what's going on there?
Yeah, I suppose you have. I'll choose two economies actually. One at either end of the spectrum. I think you've got China, and then you've got the UK. Certainly, last year, Europe and the UK were under massive pressure in terms of their reliance on Russian gas and energy costs, etc., and that pushed their headline inflation really high. But it does seem that in Europe, that's generally starting to, well, certainly the energy crisis has gone. Energy rates are back to sort of pre-COVID levels, pre-Ukraine war levels. But in terms of inflation in Europe, it's starting to look much more benign. But in the UK, I think really they're starting to see a little bit like us, or have seen similar issues to us, where they are a small island economy, and given Brexit and the fact they're no longer part of Europe, they are seeing tensions in their labour market. And you've definitely seen wage pressures in the UK be very hot. And they've had a number of sort of more recent 50 basis point rises after the Bank of England was on hold. But the expectation there is that their terminal Bank of England base rate, their OCR, will be at or above 6%, which is quite a bit higher, clearly, than even New Zealand, which is traditionally at the top of the pack, or top of the sort of G7 pack, but well above where the US or Europe is. So, that's an economy that seems to have a lot of tension in it, and probably a lot of rigidities, and that's showing.
Is that a function partly of Brexit?
I think so. I think they are seeing that there's been more costs pushed into the economy in terms of those frictions. Definitely from a wage standpoint and a labour availability standpoint, that's the case. And there may be other issues as well. At the other end of the spectrum, and I think it's a really interesting point for the second half of the year, and one that generally people are not talking too much about, but China's sort of recovery out of their COVID lockdowns has actually been pretty lackluster. And importantly, in terms of their inflation, they didn't have inflation to start with. They were sort of very much unlike the Western world from that point of view. And, broadly, headline CPI inflation is basically zero, give or take. And if you go to the production side, what they call the PPI, or the producer price inflation, that's actually pretty negative. So that is a quite an important goods impulse for the world. We are going to see sort of, again, a bit like the early 2000s, there's a chance that China starts to export a deflationary impulse around the world. And I do think that, again, that probably helps that inflation start to push back, or continue to pull back towards probably the targets the central banks have. Whether we get there's a different story, but sort of going from that 4 to 2% level looks more likely. Getting under 2 and sort of in the 0 to 2 type target the central banks may be more of a challenge, but certainly inflation from that point of view is proving far more friendly than what we probably had expected.
I guess if with China, our major trading partner, just thinking about New Zealand for a second, and if it was the alternative where there was significant inflation in China, we would be importing that in addition to our own internal issues. So with it going the other way, it will be, as you say, an impulse.
And I think
supporting rates coming down.
And I think the Reserve Bank even kind of sort of mildly touched on this in their very last OCR statement, where they said, you are seeing inflation progress around the world. So actually, from a goods standpoint, New Zealand we no longer have that inflationary pulse coming in. So it really is that sort of domestic, and we did see that in terms of our inflation numbers last week, that it is what they call the non-tradables. So domestic activity that's not sort of directly in competition with imports. It's the non-tradables that are keeping our inflation level up. The goods side is pretty friendly at the moment. You've definitely seen things like building products come back pretty quickly, and certainly consumer goods prices are not moving to the same degree. So as always, it's that sort of services side or sort of even wages. Yeah.
Okay. And what about our friends across the ditch? How are they faring?
Australia's been interesting, I think is probably the right word, and in many respects may turn out to be the lucky country once again. Yeah, they they've seen inflation, but they haven't seen the same pressures as probably ourselves or many other Western countries. It's been more benign, or it's been slower, I think, to raise its head. Some of that has to do with their wage bargaining system, which is very much based around sort of these annual large collective agreements, which tend to reset, and that does mean that there's a fair chance some of their inflation is more lagged than everybody else, but it still comes through. And you have seen that economy, or they haven't seen the rate rises that we have here. Their interest rates are still basically target is a 4% number rather than 5.5% here in New Zealand. And for that reason, you generally that economy, I suppose the markets there have been less worried about inflation, and interest rates, as I said, are quite a bit lower, to a point where we do view, and one of the positions we've had in the portfolios is we've actually been long New Zealand rates because we feel they're too high relative to Australia, and we expect that spread to narrow. We think that's appropriate over time.
Okay. Employment doesn't seem to be changing a lot in any of the countries, though. So what's your take on that?
Good question. I think we may end up with a very different picture by the end of the year. I think, New Zealand this time seems to have been an interesting canary, I suppose. Maybe that's the wrong term, but certainly a lead or a test case. I think we definitely, in terms of the positioning in portfolios, if we go all the way back to COVID, it was really interesting in New Zealand how quickly we got back to life in sort of late 2020 when the borders were closed, but we didn't have COVID in New Zealand. People very much, it was life as normal. The rest of the world was closed, and that sort of became a leading indicator to us to say that actually the rest of the world, once it reopens, will get back to life very quickly. I think here, we've seen a situation where this time, probably last year, labour demand was very high. People had, work they needed to complete but couldn't find staff. And to a degree, a lot of that was, some of that was COVID related, but a lot of that was the lack of ability to import labour. We've seen high migration in terms of New Zealand, and the numbers have been very high, sort of circa 1.5% of population, which is a really big number. That generally, there is some concern that many people coming into the country is inflationary. But I think we are seeing some clear signs already in terms of the data that actually a lot of those people coming in have been able to fill these sort of open job vacancies, and actually the demand for jobs sitting behind that is a bit weaker. So we are seeing that sort of job, certainly the wage pressure, and to a degree unemployment rates I would expect we'll start to see those filter higher. Definitely last week, the SEEK job ads, where you are seeing those ads roll off, and certainly the number of applicants per job ad is much higher than it was. And all of that is quite similar in the US to a degree. You saw they have this index called the JOLTS ad, which is job openings. And at one point that was sort of 11 million job openings with an unemployed base of about 6 million people, 5 or 6 million people. So you had a very, very big gap. That gap is narrowing and has narrowed quite materially. And again, that seems that you're seeing that sort of slow feed through, but would expect you're probably going to see quite a bit of, well, progress is the wrong word, but from an economics point of view, you're going to see more slowing in the labour market and probably a little more unemployment as we go into the end of the year.
If immigration's so high, those people come into New Zealand, they have to find jobs.
Yep.
So that's, I guess, that's going to impact the number. And then on the other side, you have a natural unemployment rate, which needs to be factored into as well.
Correct. And I think, with so many people coming in, it does make the thought, we've got to be very careful about how we think about the next 6 months for New Zealand, mainly because, if you've got 1.5% of population more here in New Zealand, effectively, as long as productivity stays relatively stable, that's 1.5% GDP growth because there are more people in the country and consuming. On the other hand, so you might end up having numbers which are maybe not massively positive, but economic activity continues to bubble along. But at the same time, probably at a per capita level because of the rises in interest rates, and which are continuing to bite. There's a comment saw recently that somewhere, probably up to 40% of mortgages still need to roll between here and sort of early next year. That will continue to bite. So you may end up seeing more of that sort of per capita recession where individually life's quite challenging, but there's actually just more of us here. So the headline numbers look a little better.
Okay. What in the Reserve Bank's last statement? How are they viewing the next wee while?
Well, I think the Reserve Bank here has been, again, an interesting leading indicator, and I think it's a very good reminder for what is happening offshore, is that the primary focus, the Reserve Bank has a number of goals, or they're tasked with a number of looking after inflation and job creation. But in that sense, it is inflation first, and its sort of growth is very much further down the path. So, in that sense, the Reserve Bank has really very clearly said that they view that their rate rises are working, that inflation is coming down, that economic activity is slowing. The fact that economic activity may remain relatively positive going forward is not really an issue. It's really about that inflation side. And markets at time, and you've definitely seen this. It's one reason why mortgages have moved. You've seen banks raise their mortgages recently, is that the market, the wholesale market, investors like us get a little freaked by seeing some good growth. But I think that's the wrong message that people are taking. Actually, if we see good growth but inflation is behaving, that's not a bad thing. And I think you can see that sort of situation where interest rates really can stay where they are and over time start to move a bit lower. So, it's not really answering a question, but very clearly the Reserve Bank has said they are very comfortable with the way things are going. They've certainly acknowledged they've got their foot pretty hard on the brake. The economy is slowing. They don't feel it's slowing too fast, and they're comfortable to stay where they are. And I think, they are of the view that they don't need to change rates for some time.
So at the end, or very close to the end of the rate rise,
correct,
sort of tightening cycle.
Yeah, and I think if we look at, say, the US, the Federal Reserve's out this week. It's likely they move another 25 basis points. The expectation is at this point, generally that will be the last. And one thing that they have said, which starts to get a little technical, but very much as inflation comes down, if they have a view as where they want real interest rates, so interest rates after inflation, if they have the view on where that level should be, as inflation comes down, in order to keep that real interest rate level relatively stable, that gives them ability to move headline interest rates, nominal interest rates down at the same time. So there is a natural process when, as inflation rolls lower, rolls back towards that 2% level, that the Fed and I think the Reserve Bank will become more comfortable with letting interest rates fall a little bit.
So you could see them moving reasonably quickly if inflation comes back at a rate that I guess gives the central banks headroom to do that.
Yeah, and I think one thing we're not discounting though is growth has been broadly pretty robust, as we continue to move through this process, as I said, there's still 40% of mortgages need to roll in New Zealand. There's still a decent probability that growth starts to roll off a bit faster, and in that case, would definitely raises the case for interest rates backing up faster.
Yeah, okay, great. I noticed something came out from Goldman Sachs last night, I think it was, saying that now they're expecting the probability of a recession in the US down at 20%, which if you compare that to be where we were, I think you mentioned 45 to 50% at the beginning of the conversation. I don't know if that was what Goldman were forecasting at the time, but it's certainly a lot lower than consensus in January.
Yeah, to be fair, Goldman's have generally had quite a positive view on the world, and I think they were originally about a 30% probability, so they were amongst the most positive in the market. They did, on the back of the Silicon Valley Bank, raise that to sort of 35% and really acknowledge that, because those regional banks are quite big lenders to commercial property and to the regional economies, that had more ability to push the economy further into recession. They've really backed off on that, and initially they dropped it to 25 and now 20, and really that is that view of that. The economy so far has been the US economy so far has been very adept at handling these rate rises, and it is worth sort of saying that one of the interesting bits about the US, and we've touched on it before, is that most people have very long-dated mortgages. You can get a 30-year fixed-rate mortgage there. And a lot of corporates, unlike here, corporates will typically borrow for 2 or 3 years, and a lot of that will be floating rate, or even if it's not floating rate, it's relatively short-term. Whereas in the US, a lot of corporate borrowing, especially at the larger end of town, will be fixed rate, and even commercial real estate borrowing will be fixed rate, and that will be for 5, 7, 10, 15, 20 years. So the feed-through mechanism of interest rates is quite different, and really that comes more through the share market and the wealth creation, or people feeling wealthier or not, rather than the impacting the interest payments they have to make.
The wealth effect, I guess, if everyone's feeling poorer, they're going to spend a lot less.
Yeah,
so
exactly.
Okay, which brings us then, I guess, if the Fed is expected to speak a bit more positively, and certainly some of the investment banks are, we're seeing that in markets now, aren't we? Take us through where have we gone from January to now? Yeah.
If I start, say, with the interest rate part of the world initially, generally that you've seen interest rates markets which have been still quite volatile, I think is the right word. You saw generally on the back of the Silicon Valley Bank, you saw quite a violent switch from interest rate markets sort of expecting or thinking there was risk of the Federal Reserve and central banks having to raise interest rates faster and more. So they were still quite, very much in a phase of moving higher. Post Silicon Valley Bank, it was very much building in price of recession and a chance of a deeper recession. So they moved lower quite rapidly, which is good for bond prices. More recently, really a lot of that's been taken out. And again, that's come from the fact that, a bit like Goldman's 20% recession probability, the market has sort of priced out recession probability. So that's a very long-winded way of saying, interest rate markets and hence bond markets have sort of muddled through this year. Generally small positive, but they've typically had a pretty volatile year. And in terms of share markets, generally much better, but there's been some quite different returns, I think is the key part. The most positive returns have really been around the AI space, and obviously you're on a call recently.
Michael Hansen.
Yes, talking specifically about that. So, people who've been watching this will know that well. But, that really has driven a very strong returns, especially in a very small group of mega cap tech companies, and those are specifically with an exposure to that space, the likes of NVIDIA and then Microsoft and Google, etc., have really had very, very strong returns. And that has translated into the technology-heavy NASDAQ index, which actually is up sort of circa 40% this year. So really massive returns after a very difficult year last year, has bounced back and is actually starting to approach the highs we saw sort of in 2020. So really strong returns. What has been interesting, though, is if you look down how that's sort of cascaded across other markets. The S&P itself, the major US share market, at a headline number, looks like it's had a really good year. S&P as of sort of last Friday was up 18%. That's a really strong number. Those are great numbers. But actually, a lot of that has been focused in a very small number of those mega cap tech stocks, which are the sort of focused on that AI space. One thing we do look at quite a lot is what we call the equally weighted index. So whilst the S&P, companies like Microsoft, Apple, Adobe, NVIDIA make up a decent amount of those, 3-4% each of that index. We look at the equal weighted one, so which really treats all 500 names equally. So they each sort of get 20 basis points. And that index is up less than half of what the headline one. So it really sort of shows how much those larger names have performed. And really that's been one of the, I suppose, the stories of this year. Either you've had tech in your market and you've done quite well, or you haven't had tech and it's been not bad, but it's been a more muted return for, if we look at, say, the Dow Jones index, that's up, that's sort of more of that traditional industrial type business. That's still not had a bad year, at up 6%, but nothing compared to that tech heavy. And, not surprisingly, if you move down to this part of the world, we tend to be light on technology stocks, or at least large technology stocks. And if we look at New Zealand and Australia, the Australian index just under 4%, up 3.9%, and the New Zealand index just over 4% for the year. So a more positive, but a more steady as she goes type return pattern.
After a tricky 2022.
Correct. Yeah.
So in context, you're still you're not anywhere close to returning to your highs at this point that you were there. But at the same time, you're seeing how quickly it can occur in the right environment. Yeah,
and look, I think that is one of the things that I try and stress to people is that share markets, you get very focused on those big down moves, but actually recovery can happen quite quickly, or even if it's not happening quite quickly, it can happen very quietly. And you can have moves where, the market might be up 50 basis points in a month or 80 basis points, and it does 1% or 1.5%. And all of a sudden you sort of put 4 or 5 of those together and you are up 5, 6, 7%. So that is always something just to remember that, certainly given things like cash at 5.5% are look attractive, and they are attractive. It's just to remember that if you're investing for a much longer time frame, really sort of looking to capture those higher compound returns out of things from equities, which tend to be much more episodic. So it's really a matter of being there. It's quite difficult to pick the timing.
The other thing is those market numbers, they often don't include dividends. So you'll have another return component which isn't reflected in the headline numbers.
Yeah.
Okay, that's all really intriguing. Tell us about China, and how has China's share market performed given the US is up, Australia and New Zealand are up a little bit. What are we seeing there?
China's been difficult is the simple answer, and their market this year is down about 3 to 4%, depending on which index you use. A lot of that happened very early in the year, and actually return over the last couple of months has really been broadly flat, mixing and more volatile, but it's been sort of broadly flat, but it's definitely been lagging the rest of the world. And the reason for that is, again, China does have some structural issues coming out of COVID. It had that long lockdown, and there was a bounce, and people expected a bounce coming out of that lockdown. But you do have a number of, I suppose, challenges in that economy, and ones where certainly I think the leadership in China is very, what's the right word? very wary of pumping too much money in. They kind of sit there and go, well, look, we saw what happened around the Western world post-COVID in terms of the money printing and the spending. And to a degree, they are dealing with some of their the leftover impacts of their own actions in terms of that sort of earlier on, sort of go back sort of another 5-6 years ago when things were more challenging for them. And in many respects, they are in a process, and they have been in a process for a number of years of looking to rebalance different sectors of the economy. Going back 3 or 4 years, very much they were concerned about lending and shadow bank lending. The fact that there was too much debt in terms of the banking system, and it was effectively kind of unregulated. It was happening either at smaller regional levels or in what we call the shadow banks. So it was corporates acting as banks, but they weren't really banks and they weren't regulated in the way. So, it's quite a crackdown on that. And really that sort of filtered through to their other issue, which is property. And not dissimilar to here, people in China definitely have this and have been taught that property is a great investment vehicle. It's a good way for them to leverage an asset and to build wealth. What you do have, though, is you have a property market there that is very extended and very indebted. And certainly amongst the developers, they have a number of what can only be described as monstrously large development or developers who hold, monstrous amounts of debt. And, that broadly, that industry is struggling. Developers are being forced to ultimately to get smaller, and the market is flat at best. And from that point of view, that's been a big engine of Chinese growth over the last couple of years. And the powers so far are holding off in terms of sort of really pump priming and coming to the rescue on that. They've helped certainly, but they're looking to do that in a managed way. Probably the other one is more a case of timing, I think, in the sense that if we look at what is happening with technology and really the separation of US tech and Chinese tech, there is that, I suppose, an interim bit where some of that US demand for tech that would have come into China is not there, and that's creating, I suppose, a little bit of a demand gap. They are, in many respects, China is ahead of the US in a lot of their technology, but in other areas they are still building up and the volume is not there to the same degree. So that is just weighing on activity. So generally, and this will be a very long answer to your question, and I'm good at that, but I think if we go back and step back and think of a very broad picture, think about what happened to Japan in the 1970s and 80s. You had an economy that rapidly industrialized and became the production house for the world. Very strong growth, and really kind of matured into that. Very much, we're seeing that situation with China now, and that they have been in the early 2000s. They were that engine of global growth, the production house. More and more they are producing for a domestic market now, and that is a maturing economy. And as a maturing economy, growth is generally slower. The expectation this year for growth is somewhere in the region of 5%. It wasn't acceptable a couple of years ago for China to have growth below 7 or 8%. So they're maturing into their place in the world, I think.
Yeah, it would have been roughly a year ago, there were significant concerns around Chinese property, which seemed to have not manifested at the level of severity that many were forecasting at the time, but equally it has been a hard time for property owners and developers.
Yep.
And during that time, just something you touched on was there was also a crackdown by Xi Jinping on the technology sector and the influence they were having locally, and that seems to be lifting a little bit, which I understand is building confidence within China to invest in that space again.
Yeah, I think, look, I probably take quite a rosy view on that, in the sense that in many respects, China has lacked a lot of the regulatory frameworks that we would expect here in New Zealand or in the US, or those regulatory frameworks have not been adequately policed. And in around a lot of the crackdown, and without a doubt there were clearly political angles to the crackdown and what happened. But in terms of focusing on a lot of the businesses, it was things like data privacy. Actually, what were they doing with the data they were getting off these apps? How were they treating people in terms of pricing? Were you getting a different price, Stephan, because you wore a black suit versus me wearing a blue suit gets a different price? Almost that sort of profiling type situation. So, in many respects, a lot of that crackdown was actually about saying to people that actually this is the framework which we operate as a country. People need to have faith in that, and we are going to enforce that. I think as we have come through that, you've definitely seen the really big platform businesses, the likes of Alibaba, Meituan, the food delivery business, Didi, the rideshare company, back and operating pretty normally, and certainly seem to be in the good graces. So they've kind of worked through that process, which is a positive.
So one interpretation is another form of China maturing as a country.
I think so. What is really interesting for us is that because of things like that crackdown, because of the slow growth, that it really is priced into their share market. As I said, it's had a tough year this year. A lot of that was very early in the year. We're now down about 50% off the peak that was seen a couple of years back. That's a long way down. And in many respects, Chinese shares are as cheap as they've ever been. So from that point of view, in the portfolios, we do have a small overweight to China for that reason, that actually, being patient, we think that economy is still, there's no reason it may be a challenge in the short term, but that is still a growing economy with some great technology, great businesses, and you can buy them very cheaply. So there is value to have a small position in the portfolios.
Fantastic. Okay, commodities is the last asset class that we really focus on. Take us through where that's gone year to date, and then we'll flip over to the opportunities that you're seeing moving forward.
Yep. Commodities, to be fair, have had a pretty challenging year, which is, on one hand, given growth has actually been better than expected, you would sort of say, well, that seems odd. On the other, as we just talked about, China's been pretty lackluster in terms of activity. And again, China is a very large consumer of many of the world's largest commodities. So from that point, there has been some yin and yang going on there. I think, what is the other aspect which we are seeing more and more, and in terms of number of markets, is the underlying demand and supply. We're still working through that process post COVID, where you had markets where people couldn't get commodities, and then they really sort of not overconsumed, but they hoarded commodities and definitely demanded them and built up local supply of inventory. So, across a number of markets, we've had a situation where really this year it's been about that inventory drawdown. But if we look forward over the next 6 months or year, there's almost sort of record levels of a mismatch between demand, because global demand is generally more robust. We have seen strong demand, but actually the supply levels of commodities more generally are very low. So, we still have pretty positive outlook for the commodity world. Again, come back to the whole process of deglobalization, the whole process of electrification. All of those mean that there's more demand for commodities going forward. So, we're pretty positive on the space. Very wary that it has been volatile. That has actually, we've had small commodity positions, and that's detracted from our performance this year. So going forward, keeping positions small, but still want to be exposed to that space.
Yeah, there's funny electrification and as one example, but obviously there's a huge demand for infrastructure worldwide as well, which you would expect. Once I guess governments get over their debt burden challenges, we'll see a real push towards demand for those raw commodities that which we hold in the portfolios.
Or even, you look at something like, that electrification process. I think, and don't quote me on this, but I think China has potentially seen numbers that they're expected to install the same amount of solar this year in 2023 as the total installed base in the US, period. So, solar panels take silver. There is a massive demand for silver, but we haven't really seen silver prices respond to the same degree. So, that is a case of that sort of inventory versus demand coming down the pipe.
Okay. Looking forward, you I guess in the context of an environment where technology has moved in price a lot, but a lot of industrials and other sort of value-orientated or cyclical stocks haven't moved as much. Where there's obviously a lot of opportunity out there now. How are you thinking about capturing that opportunity?
Look, there's always a lot of moving parts, but I think for us, it's about sort of going back to basics. And what we've been saying to clients is, if we look at the two broad areas, if we look at, say, where interest rates are and what that means you can get from fixed interest investments and where share markets are and what share markets are likely to do going forward. In terms of interest rates, we all know that interest rates are as high as they've been effectively in the last 20 years. So from that point of view, being able to buy, to start with, being able to invest in cash investments at sort of 5.5%, it's really attractive. Maybe not for a long-term investment, but certainly attractive for the short term. Moving up into bonds are based effectively off that cash rate. So if you're able to get a bond between, say, 5 and 7%, that's a really interesting level to own. So we like that. And then if you go to share markets, yes, parts of the technology space are very excited about AI, and there's probably good reason for that. It's a question of whether those prices have run too far, but certainly there is a theme there that seems to have some, a long-term runway ahead of it. But if you step back to share markets more broadly, they are much more fairly valued. And in many respects, I've sort of, I suppose, compared it to, or again, we're talking about the US market specifically here, but compared it to, say, what's happened in New Zealand property. Got very, very expensive given demand levels, and the US shares did, and then they came back pretty aggressively last year, or very aggressively last year, sort of circa 20%. Much like the property markets come back quite hard. Here and now, valuations seem much more normal. Maybe not super cheap, but certainly more normal and closer to their fair value trends, I think, is what I'd say. The other one is, if we look around different parts of the world, again, we've talked on China, but another one is Europe is very cheap compared to where it's been historically. So growth in Europe is still muted, and you've got the European Central Bank still raising rates there at the margin. So difficult to sort of see growth taking off in Europe. And again, they tend to be quite technology light, their share markets, but at the same time, you're not paying a lot. So that's sort of a roundabout way for us to say that actually, if we really step back, different asset classes look like they're either normally valued to cheap, which would be in the case of interest rates, or in shares pretty fairly valued. And from that point of view, that sort of comes back to say, well, we want to be invested in both. Need to be relatively close to our benchmarks because the world's mostly a pretty normal place, and you just sort of let time do its job at that point. As I said, you can sort of find that markets move up 0.5%, 1% over a month or a couple of months, and then that builds on itself, and that's how you sort of build long-term returns. Over time, it compounds. That's the plan. Not timing the market, time in the market. Okay. I guess the last question for me is, in New Zealand, because obviously we are a New Zealand-orientated business, we have a currently reasonably large allocation towards local markets. And there are certain securities that you're more excited about. You want to take us through a couple of those and what's driving your positivity on those businesses? Yeah. In terms of people's growth portfolios, just useful to sort of remind people actually is that especially when they look at an S&P that's up 18%. In terms of people's growth allocations, if you are invested in growth with New Zealand funds, broadly it's a third is invested in New Zealand shares, a third is in global shares, and then a third is more in the thematic space, which is generally tends to be predominantly global shares, but with a little bit of a smaller amount of commodities and a small amount of crypto assets in there, which actually is one space we haven't talked on. And actually that's one of the markets which has, again, in that sort of theme of things happening very quietly, has had a great year. So Bitcoin this year is up 82%. Ether is up 57%. Really that is, and certainly with Bitcoin sort of hovering around 30,000, it is that sort of point where those returns have happened very quietly, and it's sort of taken out some of that excess, or a lot of that excess, and the sort of that gambling aspect about the headlines of crypto, and maybe some of the it suggests that some of the more fundamental reasons for those assets are starting to come through over time. So we're still pretty positive that we only have a small allocation in the portfolios.
But just before you move on, the institutionalization of, if that is a word, of Bitcoin seems to be growing with, I believe, multiple major fund providers, BlackRock, I believe Vanguard too, and some of the others iShares, producing ETFs. And also there's continuing discussions around how crypto or digital assets are regulated. So do you just want to touch on that?
Yeah. Well, certainly, the behemoth out there is BlackRock. Recently, they just passed, I think, $1 trillion in assets under management, which is an unbelievably large figure. But essentially, they have, they created quite a bit of market excitement in that they filed effectively for a Bitcoin ETF in the US. And that was sort of, kind of the stamp of approval of the world's largest fund manager, which got a lot of people excited. On the flip side, there is quite a bit of regulatory action out there. Primarily, the SEC is wanting to take Coinbase and a few others to court to say that they were offering securities. Some of this, to a degree, is what I'd call a turf war in the sense of US regulatory entities. The SEC can regulate securities, and what they want to do is define Bitcoin as a security. Otherwise, it goes to another regulator if it's not a security. So, but stepping back from that, I think, more regulation to me is a positive. I think, one of the despite being, and this is a very personal view, but despite being hailed as something which was truly decentralized and had no sort of governmental involvement, I think people take faith from a regulatory framework. They like to know the box in which they operate. And the more regulation, or at least getting the regulatory framework, I think is a positive for that space. So, I think there'll be challenges as we go forward, and, we still might see that market pull back a bit, but the steps are positive, and again, a bit more of a maturing market, I think, there.
Fantastic.
But coming back to your actual question, in terms of the New Zealand names, really, I think I was tempted to say boring, but they're anything but boring. But, the beauty about the New Zealand share market is we've got these really large cap, blue chip names that basically dominate the market. And it does mean that you don't need to, there's no need to chase some small cap names, because you actually get great returns out of the big names in New Zealand. And in terms of, there's probably two themes in terms of, you look through the top 10 names, and top 10 names are Contact, Meridian, Chorus, Mercury, Telstra, Spark, Ryman, Somerset, Fletcher Building, and CSL, an Australian blood products business, which probably people don't know. But if I think the themes of those two is really, you pretty much got three themes. You got electricity, you got telecoms, and then you've got retirement villages. And, I'll just sort of probably focus on the electricity side and the retirement villages. Electricity, again, come back to the population discussion. Population is growing. The cost of producing electricity is pretty fixed. It doesn't tend to, the inputs aren't getting a whole lot more expensive thanks to the inflationary framework. So their inputs are relatively fixed, yet demand is increasing. that is good for electricity providers. So more demand, the more they're going to make. So we're positive on that.
So that translates to increased power prices, I guess, and then margin expansion, which ultimately means more profits for power companies and better returns for shareholders.
Yeah, exactly. And in fact, pretty much all of these businesses have great dividends as well. So in an environment where the cash rate is much higher, I think it is good, definitely, that a larger chunk of your return comes from that more predictable dividend stream. It really means that you're getting that return up front rather than waiting for it in a more episodic capital gain that will come at different points in time. But in terms of if I sort of switch from that to the retirement villages, and I think actually they're not far from a retirement village, but if I put Fletcher Building in that group as well, again, these are quite cyclical names, big cap names, but very cyclical. And much like a discussion of sort of shares in general and the property market, these names have come back in some cases pretty by very large amounts, really in terms of what's happening in the New Zealand economy, in terms of what's happening in interest rates, and in particular what's happening in terms of property prices. So clearly Ryman and Somerset are big owners of property, residential property, the retirement villages, and Fletcher Building, being a provider of property building products and being a property developer themselves, very focused or very tied into that cycle. And again, we think that those declines, which have been material, correctly price in what we've seen in terms of markets. But actually, as we go forward, valuations are pretty cheap. And I think the standout view is Ryman. In terms of its highest valuation was a number of years ago, sort of 5 years ago, where you effectively were paying 4 times their built base of properties. That was the share price was 4 times higher than what the value of their properties were. Now that built in a lot of growth, and they were in a big growth phase, so you essentially were purchasing that growth, but valuations were very high. Flip to now, that share price is somewhere 50+ % off its peak, and you're buying their property their portfolio of properties at essentially less than its book value, so less than what it's worth. You're paying about 80 to 90 cents on the dollar. To us, that seems a really good asset to own for a long period of time. So that's why it's one of the larger positions in the portfolio.
I guess it assumes there's no growth at one level. That's what current price is telling you. And it ignores the fact that there are, demographically speaking, significant tailwinds underpinning the business model that they have.
Yeah. And I think it's a bit of a tangential answer to your question, but for us, it is about saying first, at a very first stage, if we're looking at a share, is this business going to be here in 5 or 6 years? That's almost the number one question of answer. Then you can actually go and look at its proper financials and think of what the prospects are. But something like a retirement village that fulfills a key role in an aging population, where essentially the government has said we want private providers to help us in that path forward.
Yeah, and a growing population too.
Correct.
Fantastic. And so you mentioned 3 themes. So we've got electricity, property and retirement villages, and there was a third?
Essentially telecoms, I suppose, and we've got Telstra and Spark, really probably the most interesting one there. And probably as a New Zealand consumer, I'm not that keen for it to happen here, but what we've seen out of Telstra is really interesting is, domestically here, and it's very much a global phenomenon, is that your phone bill hasn't really gone up in price much over the last 10 years, I suppose. In Australia, you are now starting to see phone contract prices move up with the rate of inflation. And they've come from a period of very aggressive competition between the different players. That has backed off, and you are seeing those prices move up with inflation. And that is, that's the first time that's really happened in mobile price plans for really for years and years and years. And that underpins the valuation of that business actually getting such a large what usually is slow growing business into a growth path because of prices moving higher. So that's really attractive for Telstra. Spark, as I said, I'm not sure I really want to see that domestically from my own pocket, but we'll see.
Yeah, I guess those businesses are a little bit like electricity providers, aren't they? And that they've got fixed asset base, and other than buying a little bit of satellite space or something that they need to be able to scale up more consumption, they that gets passed on straight through to the bottom line.
Yeah, and I think I've said it before, but number 3 in our holding list, which I've left out, but I put in that telecom space, is Chorus. The owner of effectively the lines company for New Zealand Internet, and we saw during this the really difficult period of Cyclone Gabrielle that actually people started to refer to the internet as a utility, which was really, I think, the first time I'd seen it sort of publicly discussed at a at a general public level, that internet is a utility, and that's very much how we view Chorus, and for that reason would sort of price it like an electricity company.
Fantastic. Mark, thank you. Really great overview of where we've come from, where we've been through in the last 6 months or so, and where we're going. So thank you for your time. And
my pleasure.
I look forward to speaking again soon.
Cool. Thanks, everyone.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme, the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.